So, a tech giant is making an absolutely massive $18 billion bet. And today we're going to break down exactly what that means, how they're doing it, and, whether it's a stroke of genius or just a massive gamble. Let's dive in.
Okay, let's just start with the number itself. $18 billion. To give you some perspective, that's more than the entire annual GDP of countries like Iceland or Jamaica. This is the kind of number that doesn't just make Wall Street pay attention, it makes the whole market hold its breath.
Right. So the obvious question is, how on earth does a company like Oracle even go about borrowing this much money? And probably more important, why would they? It's not like they can just stroll into a bank and ask for a loan of that size. The answer lies in something called a corporate bond. The easiest way to think about a corporate bond is as a giant IOU. Oracle is basically going out to thousands of investors, big and small, and saying, hey, lend us your money and we promise to pay you back down the road with interest. By selling all these little IOUs, these bonds, they can raise billions of dollars directly from the market. But, and this is where it gets interesting, Oracle isn't just offering one single type of IOU. Nope. They're offering a whole menu of them, which they call notes. And you'll see these notes have different maturity dates. That's the year Oracle has to pay the loan back. And crucially, they come with different interest rates. And this is where we see a really fundamental principle of investing start to play out. And this right here illustrates one of the core ideas in all of investing, risk versus reward. Look at this. If you lend Oracle money that they promise to pay back pretty soon, by 2030, the risk to you is lower, right? So you get a lower interest rate, 4.45%. But if you're willing to lend them money for over 40 years, all the way until 2065, well, the risk is much, much higher. So much can happen in 4 decades. So to make that risk worth your while, Oracle has to offer a much bigger reward, a 6.1% interest rate. All right, so we've got the how. We know how they're getting the cash. But now for the really big question, why? What on earth does a massive global company like Oracle plan to do with an extra $18 billion just lying around?
Well, if you look at the official filing, you get the standard corporate answer. The money is for general corporate purposes. It's kind of this vague catch-all term that can mean anything from building new data centers to paying off older existing debt. It also covers things like paying dividends or buying back their own stock. But a lot of analysts think the real story here is that they're gearing up for a huge push into AI and cloud computing to take on their rivals. Or maybe even a huge new acquisition.
And of course, borrowing money on this kind of epic scale is not free. You see this number? Over $54 million. That's the underwriting discount. That's basically the fee that Oracle pays to the big investment banks just for organizing the whole deal and finding buyers for all those bonds. It's the cost of doing business when you play in the big leagues. Okay, so whenever a company makes a move this big, it's going to get people talking. The whole market starts buzzing. So let's take a look at how people are reacting. Is this seen as a brilliant strategic move, or is it a sign that a company is taking on way too much risk? Well, the signals are complicated. And when you look at what the Wall Street pros are saying, wow, the predictions are all over the map. I mean, it's pretty wild. You've got some analysts who see the stock dropping to around $177. At the same time, the most optimistic folks see it going to over $340. That huge gap just shows you how much uncertainty and disagreement there is among the experts right now. So why the huge disagreement? Well, it really boils down to two completely different stories about Oracle's future. The positive story? Oracle is borrowing big so they can invest in the future, in things like AI and the cloud, and position themselves for massive growth. The pessimistic story? They're taking on a mountain of debt right as competition is getting tougher than ever, and companies are starting to tighten their IT budgets. But here's the kicker. While the professional analysts are all torn, it seems like everyday retail investors have a very different take. Looking at the data from Capital.com, more than 87% of their client positions are long. That means they're betting the stock price is going to go up. Only about 13% are betting against it. And this creates that classic fascinating dynamic, right? It's the experts versus the crowd. You have Wall Street, which sees all this complexity and risk, and then you have the broader crowd of investors who seem to be looking at the same information and seeing a clear opportunity. The multi-billion-dollar question, of course, is who's going to be right? So, after all that, what's the big takeaway here? What should we really remember when we see a huge headline about a company borrowing billions and billions of dollars? You know, maybe the clearest warning of all comes from Oracle itself. Yeah. Buried deep in their own filing, in the part called Risk Factors, is this sentence they are legally required to include. It says, increased leverage, which is just a fancy word for debt, may harm our financial condition. In other words, even they are telling you this is a gamble. Taking on all this debt could totally supercharge their growth, or it could become a massive weight around their neck if these big bets don't pay off. Which leaves us right where we started, with the ultimate question. When a tech giant makes an $18 billion move like this, are we watching a sign of confident, bold ambition to go out and dominate the future? Or is it a really dangerous gamble that could weigh this company down for years, maybe even decades to come? That is the question at the heart of Oracle's huge bet.